Welcome to the Deep Dive. Today, we're really tearing into the sources for POET Technologies, Inc. That's ticker POET on the NASDAQ. They're a photonics pioneer sitting, right at the crossroads of high-speed data centers and this relentless AI boom.
Yeah, and our analysis today is pinned to October 7th, 2025. The closing price then was $6.38 a share. But really, the big story, the catalyst, is this huge capital infusion they just got.
Huge is right. A landmark US $75 million, and interestingly, from just a single high-conviction institutional investor.
Shows real belief.
Exactly. So our mission today is pretty straightforward. Let's unpack that massive show of confidence, look closely at the underlying technology, and figure out if that $6.38 market price actually holds up against the fundamentals and, well, the future potential.
And it really boils down to execution. It's purely an execution play at this point, and the market is definitely pricing in, let's say, a lot of future success.
Right. And here's the hook for you listening. By the end of this deep dive, we're going to share the intrinsic value range we came up with. Now, it's based on a highly speculative model, looking way out into the future.
Very speculative, yes.
But you'll see that the current $6.38 price, it falls right smack in the middle of that range, which tells you this company is truly at a pivotal moment, an inflection point. Okay, let's get into part one, the fundamentals. Chapter 1, business analysis.
All right, let's start with their core strategy. POET uses what's called the fab-light model. Basically, they've learned from the semiconductor world.
Meaning they don't want to build those incredibly expensive factories, the fabs.
Exactly. Building multi-billion-dollar fabs is just too capital-intensive, too risky for a company their size. So instead, they focus their money, their capital, entirely on what they do best. Proprietary IP, the chip design, that's their core competency.
Okay.
And then they leverage manufacturing partners for the actual high-volume production. It makes the business model much more scalable, potentially.
But also dependent on those partners, right?
Absolutely. Success really hinges on those manufacturing relationships working smoothly.
And the tech they're designing around this IP, it sounds pretty revolutionary. It's their patented POET Optical Interposer. Can you explain that a bit? Think of it as like a foundational building block.
Yeah, that's a good way to put it. It essentially allows them to seamlessly integrate everything, the electronic bits, the ICs, and the photonic devices like lasers and detectors, all onto a single wafer at the wafer level.
Which is a big deal in photonics.
A huge deal. And this platform is what enables their actual product lines, which are all aimed squarely at, solving these data center bandwidth bottlenecks we keep hearing about.
Gotcha. So the product's built on this. They have light sources, things like POET Starlight and POET Lightbar.
Right. Those are specifically targeting things like AI systems and, importantly, co-packaged optics, or CPO.
CPO. That's where they put the optics right inside the chip package of the silicon, isn't it? That's sort of the separate modules outside.
Exactly. Closer integration, better performance. And then you have their sort of main product line, the optical engines, names like Legacy, Infinity, Teralight.
And these are the workhorses.
Pretty much. They scale from 100 gigabits per second all the way up to, well, an insane 1.6 terabits per second. These are the guts inside the optical transceivers that power the biggest AI clusters out there.
What seems really fascinating here is their whole value proposition. They call it the semiconductorization of photonics, which sounds impressive, but what does it actually mean for a customer? For decades, making photonic stuff was apparently very manual, expensive.
Oh, incredibly so. Slow, costly, required really complex active alignment. You literally had technicians, or maybe robots, painstakingly lining up tiny fibers and lasers under microscopes.
Wow.
Yeah, drove up costs, power consumption, everything. POET wants to completely disrupt that.
What are the pillars of that disruption?
It really comes down to 4 key things, enabled by moving to that wafer-level process with the interposer. First, significantly lower cost. Second, dramatically lower power consumption. Third, much smaller size.
Okay, cost, power, size.
And fourth, maybe the most crucial one, massive scalability. And they get that scalability through passive alignment.
Passive alignment, meaning it just lines itself up during manufacturing? No fiddling?
Basically, yes. They use precise semiconductor manufacturing techniques, things that are already standard, to automatically get the components aligned. No manual tuning, no complex robots needed for that step. That's the core advantage, the potential game changer.
And the timing for this couldn't be better, could it? POET seems positioned right in the middle of this AI gold rush.
Absolutely. AI workloads are just creating this explosive, almost insatiable demand for faster optical connections.
The market numbers are huge, too. The global data center optics market. Already big, but forecast to grow at, 11.5% CAGR? reaching nearly $30 billion by 2033.
Yeah, huge market. And if you connect that to the bigger picture, the opportunity looks even, well, starker. There's a potential shortage looming.
A shortage.
Uh-huh. There was a McKinsey analysis suggesting that for 800G transceivers, the really high-speed ones needed, now industry production, might fall short of demand by something like 40% to 60% right through 2027.
Wow, 40 to 60% shortfall.
Yeah, it's a massive gap. And that projected supply-demand imbalance, that's exactly what POET's scalable automated platform is designed to fill.
Okay, but it's not like they have the field to themselves. They're up against some serious giants, right? Broadcom, Coherent, multi-trillion-dollar companies.
Oh, absolutely formidable competition. Those guys have huge market share already, deep pockets, and really strong established relationships with the big data center customers.
Well, how does a smaller company like PO8 even compete? What stops the giants from just crushing them?
It really comes down to their defenses, their barriers to entry. First, there's the IP moat. POET holds, I think, 77 granted patents protecting that optical interposer technology. That's significant.
Okay, patents help.
And second, the sheer technical complexity. This isn't easy stuff. It requires years and millions in R&D just to get close. POET themselves spent something like $60 million over 5 years just to get to the point where they're ready to commercialize. That's a pretty high barrier.
Chapter 2, Management Evaluation. Okay, that brings us to the leadership. The CEO, Dr. Suresh Venkatesan. His background seems, well, like a major asset right now.
It really is. His track record is incredibly relevant to the main challenge POET faces now, which is scaling up complex manufacturing.
Because he did that before at Global Foundries.
Exactly. He previously led the development and the high-volume manufacturing ramp-up for critical semiconductor process nodes, specifically 28 nanometer and 14 nanometer.
Okay, for listeners, process nodes like 28 millimeter, 14 millimeter, that tells you how tiny and complex the chips are. Successfully leading the ramp for those means he has real, practical, hard-won experience.
Right, turning really complex cutting-edge designs into reliable products made in huge volumes globally.
That is precisely the expertise you'd want for a company trying to push a novel photonic approach into the mass market, right? That feels like a huge de-risking factor.
Definitely. Now, historically, if you look at their spending, their capital allocation, it was almost purely R&D, just feeding that long development cycle.
Yeah, the numbers were stark. R&D costs hit like $4.3 million in just Q1 2025, completely dwarfing any revenue they had. It was all about building that foundation.
But this new $75 million financing, it really signals a fundamental shift, a strategic pivot. That money isn't just for more R&D.
What else is it for?
It's earmarked for scaling up operations, sure, but also critically for funding targeted acquisitions.
Ah, acquisitions. So inorganic growth, too.
Exactly. It suggests management feels the core tech is now sufficiently de-risked. They're confident enough to start buying other pieces to accelerate getting into the market. We already saw a hint of this when they bought the rest of their joint venture, Super Photonics Siamen.
Right, SPX.
Now, we do need to be really clear about the financial reality here. The return on invested capital, ROIC, it's deeply negative, around minus 64%, give or take, on a trailing 12-month basis.
It sounds terrible.
It does, but for you listening, it's important to understand this is not necessarily a sign of failure at this stage of a company's life.
Okay.
It's really just quantifying the incredibly high rate of investment, the cash burn that's absolutely necessary to build what they hope will be a multi-billion-dollar business platform from scratch. You have to spend money to potentially make money later.
Chapter 3, Financial Analysis.
Yeah.
Okay, so sticking with that venture capital sort of mindset,
Yeah.
let's look at the current financial snapshot. Market cap around $610 million.
Roughly, yeah.
Trailing 12-month revenue.
Yeah.
Just under $470,000.
Tiny.
Almost nothing, relatively speaking.
TTM operating profit margin.
Yeah.
A mind-boggling negative 6,000%. And TTM free cash flow is negative $38.5 million. So basically, they're still burning cash like crazy, like a pre-revenue biotech almost. Precisely. And that context is exactly why that $75 million equity infusion is so transformative. It's a massive financial stability event for them.
How so?
Well, immediately it boosts their cash balance to what they're calling a war chest of over $150 million, and importantly, with no significant debt.
Okay, $150 million cash, little debt. That's a strong position.
It is. Their debt-to-equity ratio drops dramatically from about 0.13 down to around 0.05. This single move gives them a runway operationally for multiple years. It massively mitigates that historical risk of constantly needing to raise more capital, maybe on bad terms.
Got it. Now, given those huge losses, obviously standard PE valuation is totally useless here.
Completely irrelevant, yeah.
But if we look at price to sales, the PS ratio, you mentioned this earlier,
Like that.
it's astronomical, 1,236.92 times trailing sales.
Huh.
Compared to an industry average of maybe, what, 56x, over 1,200 times sales. It just sounds like pure hype. How on earth do you even begin to justify that?
Well, you're right. That number screams speculation. It confirms the valuation is based purely, entirely, on exponential future revenue potential. It requires, frankly, extreme faith in their ability to execute.
So how do you model that faith?
The only way is with a discounted cash flow, or DCF, model, which, by its nature for a company like POIT, is inherently highly speculative. It's all about projecting future cash flows based on incredibly aggressive growth assumptions.
How aggressive? What kind of assumptions do you need to make to get anywhere near the current stock price?
Well, to justify today's price, the model needs things like initial annual revenue growth well over 100% per year.
Wow, doubling revenue year after year.
For a while, yes. And then eventually settling into mature operating margins of maybe 20–30%. Plus, you have to use a very high discount rate we use between 15% and 20%, specifically to reflect that huge execution risk we keep talking about.
Okay, so you plug in hypergrowth, solid future margins, and a high-risk discount rate. What does this speculative DCF model actually spit out?
After all that, the estimated intrinsic value range comes out somewhere between $5.92 and $7.07 per share.
And remember, that's $6.38 starting price.
Falls right in the middle.
Perfectly within that highly speculative range. It really highlights the situation. Okay, let's shift gears into part 2. Market dynamics, risk, and conclusion. Chapter 4, market sentiment. So what's the vibe out there? What are analysts saying?
Well, the analyst consensus is actually overwhelmingly positive. You see mostly buy or strong buy recommendations.
And price targets.
The average 12-month price target seems to cluster pretty tightly, somewhere between $6.25 and $6.77. So generally supportive of the current levels, maybe a little upside.
And that big $75 million investment we discussed. How's the market seeing that?
It's definitely viewed as a major validation, kind of the culmination of a string of positive news they've had, including winning that Most Innovative Award at the ECOC conference in 2025. It really signals that serious institutional money is now buying into the story, believing the tech is commercially ready.
Okay, but despite the positive analyst views and the big investment, you mentioned it's still a battleground stock. What does that mean here?
It means there's significant skepticism out there, too. You see it clearly in the short interest numbers.
How high is it?
It's sitting at 7.33% of the float. That translates to about 6.17 million shares being sold short. That's a decent chunk of people betting against the stock.
And what's really interesting you mentioned is the cost to borrow those shares to short them.
Yeah, the borrow fee rate is apparently over 20%. That's really high.
Which means it's expensive to bet against POIT right now.
Very expensive.
Yeah.
And it creates substantial pressure. If the stock keeps climbing or if there's more good news, it could trigger a short squeeze where those short sellers are forced to buy back shares to cover their positions, potentially driving the price up even faster.
Okay, and technically, what does the chart look like?
From a purely technical perspective, the stock is clearly in a bullish trend right now. It's trading strongly above both its 50-day moving average, which is somewhere in the mid-$5 range, and its 200-day moving average, down around $4.91.
So the chart confirms an established long-term uptrend is in play.
Seems so, yeah.
Chapter 5, ownership structure. Now, you mentioned the ownership structure has changed significantly because of that big investment. That sounds important.
It really is potentially a major long-term positive. Historically, POIT's stock was very diffuse, mostly held by retail investors, maybe around 90%.
Which can mean more volatility, right?
Often, yes. But post-financing, the structure looks very different. It now has a crucial institutional anchor.
How so?
Well, that single new investor who put in the $75 million will hold roughly 13% of the company.
Okay, one big holder.
And if you combine that with another significant institutional holder, MCAP International, which holds about 6.5%, you now have two institutions controlling nearly 20% of the company.
So almost a fifth of the company held by just two institutions.
Right. That shift should, theoretically, lead to less day-to-day volatility and maybe a stronger focus on long-term fundamental value compared to more trading-oriented retail patterns.
Makes sense. What about insiders? Are they buying or selling?
We always check that. There has been some modest insider selling over the last 12 months, nothing too alarming. But interestingly, if you look back a bit further to January 2024, there was actually a cluster of open market buying by the CEO and the CFO
Oh. At what prices?
at lower price levels than today, which you could interpret as signaling their own conviction earlier on that the technology could successfully navigate this commercial ramp-up.
Chapter 6, Risk Assessment. All right, let's pull together the biggest risks here. What are the main weaknesses, the internal risks?
Well, the key internal weaknesses are pretty obvious, really. First, they still lack significant commercial scale revenue. They absolutely need to prove they can scale from, less than $500,000 to tens or hundreds of millions.
The execution challenge.
Exactly. Which ties into the second point, the promise of low-cost, high-volume manufacturing using their platform. It's still largely unproven in terms of execution at scale. The theory is great, but can they deliver consistently in volume?
And dependence on key people, presumably, like the CEO?
Always a risk in smaller tech companies, yes. Dependence on key personnel is definitely there.
Okay, those are internal. What about external threats, things outside their control?
Right, the threats. First, as we mentioned, competition. Those giants like Broadcom and Coherent have deep pockets and existing customer relationships that are hard to break into.
Very sticky relationships, usually.
Very sticky. Second, macroeconomics. If high interest rates persist, it could potentially slow down the big, capital-intensive data center build-outs by their major potential customers. That could delay crucial design wins for PUIT.
And third, a big one these days, geopolitics.
Yeah, geopolitical risk is huge in this sector. We're talking about U.S.-China trade tensions, potential tariffs, supply chain bottlenecks.
Why is that such a big risk for photonics specifically?
Because China has significant control over some critical raw materials needed for photonics components. Things like gallium and germanium.
Ah, they're rare earths and critical minerals issue.
Exactly. If China were to restrict exports of those materials, for whatever reason, it could seriously disrupt or even cripple production for companies reliant on those supply chains.
That sounds like a very concrete threat. How is PUIT trying to mitigate that? Are they just hoping for the best?
No, thankfully. Management seems acutely aware of this and is proactively implementing what they call a China plus one strategy.
China plus one, meaning diversifying manufacturing away from just China.
Precisely. They're actively working on establishing manufacturing capabilities and partnerships in other locations, specifically mentioning Malaysia as a key part of building resilience.
Okay, so they are taking direct steps to build a more robust supply chain, less vulnerable to those specific geopolitical tensions.
That seems to be the plan, yes. A necessary move.
Chapter 7, Conclusion. All right, let's try to wrap this all up. The investment arguments.
Yeah.
Let's start with the bull case. What are the key pillars supporting investment here?
Okay, the bull case, I think, rests on four main pillars. One, genuinely disruptive, patented technology that promises significant cost and power advantages.
Pillar 2.
The massive AI market tailwind, just huge, undeniable demand growth for what they make.
3.
That newly fortified balance sheet, the $150 million in cash, pretty much removes the immediate financial survival risk, gives them breathing room.
And 4.
Leadership, specifically a CEO with direct, relevant experience in scaling complex semiconductor manufacturing, which is exactly what they need to do now.
Okay, sounds compelling. Now, the bear case. Why might someone bet against PUIT?
The bear case is also pretty simple and potent. One, the history. Zero meaningful commercial revenue so far, just consistent losses.
Sure.
Execution risk. It's still unproven whether they can actually deliver their technology at mass production scale reliably and cost-effectively. Competition. They face fierce opposition from deeply entrenched, incredibly well-funded incumbents who are not just going to roll over and give up market share easily.
Okay, so pulling it all together. The final verdict.
Well, as we said, we reiterate that the current share price of $6.38 sits right in the middle of that highly speculative intrinsic value range we calculated, the $5.92 to $7.07 range.
So the market price reflects the high-risk, high-reward scenario.
Exactly. PUIT is no longer really fighting for financial survival thanks to that big funding round. They've bought themselves time. Now it's purely 100% a question of commercial execution. Can they actually deliver on the high-volume, low-cost promise? That's the entire story now.
The inflection point.
Precisely.
So what's a final provocative thought for our listeners to chew on?
I think the ultimate determinant of success here hinges entirely on one thing. Converting that theoretical cost and power advantage into actual sticky multi-year customer design wins.
Getting the big customers to commit.
Right. And you have to remember, these large data center customers, the hyperscalers, they have rigorous qualification cycles. It can take years for them to fully test and commit to a new, relatively unproven technology provider like Poet.
It's not a quick sales cycle.
Not at all. So the next few years are absolutely critical. They will test whether Poet can actually convert that potential, those initial positive signals, into real, recurring, high-volume sales. That's what truly matters now. Everything else is noise.
A perfect summation of this high-stakes deep dive. Really fascinating company at a crucial time. Thank you for joining us today. And before you go, please remember to like and subscribe to Stock Analytics AI right here on YouTube. For just €4.99 a month, members get access to our full playlist. That's 500 deep dive videos covering all the S&P 500 stocks.
Great value.
And next up, exclusively for members, we are tackling the NASDAQ 100. Plus, members can request stock deep dives. Just drop the ticker symbol in the comment section and we'll get a deep dive turned around for you.
And finally, the necessary disclaimer. Please remember that this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice.
That's right. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.